Andrew with Jesani Wealth Management. And in the previous video, I discussed private credit as an asset class and the general idea of what a private credit fund is, how it works, why it's grown so significantly in the past 10 years, and some of the pros and cons. But I wanted to dig into one of the pros and one of the cons a little bit more because it's really brought private credit to the forefront, and that is the return that it generates versus other fixed income asset classes. So it wouldn't make sense to compare private credit to equities because private credit is not a growth vehicle. You're simply going to get your mortgage payment every month, which is going to be 7, 8, maybe 9% or lower or higher, depending on the credit fund. But you're not going to see any growth no matter how well the credit markets do, or how well the stock market does, or how well the real estate market does. So this can be an attractor for some investors and a downside to others. But remember, your upside is limited. So when looking at other fixed income assets, which I'm just going to start with 2011 here, and I'm going to forget about the returns and just go down the line. You have private credit, investment grade bonds, treasuries, high yield, which is junk bonds, senior loans, and cash. Now, this is showing you the return of each of those going out to 2020. And I know that in 2021, of course, we know that all of the bond sections of this, so high yield treasuries and investment grade bonds, are much lower than they were in 2020. And private credit was at about 8.8%, which I'll show you. But you can see fairly consistently, you see private credit in the number one spot there. And if not number one, number two, and here we were in number 4. But you can see it's one of the highest yielding fixed income investments. And with what's happening in the bond markets and with interest rates right now, it's also pushing the private credit markets and bringing more investors into it simply because of the yield that an investor can get from it. So here it is. This is up through 2022. They added in mezzanine here and also real estate senior loans. And then here's what we were looking at before, the high yield or junk bonds, U.S. infrastructure debt, investment grade bonds, and of course the 10-year treasury. And you can see that private credit came in at 8.8%, which far outpaced those other asset classes. But of course, there's a trade-off here. And remember, the main one is liquidity. These assets right here, all the high yield bonds, the infrastructure debt, the investment grade, are completely liquid. You can sell them any day like a stock. Private credit investments can be quite illiquid, and you can certainly lose money if you exit one of those funds before the required hold period. But when you look at overall volatility, which is probably the most important thing and the first thing that you want to look at, completely despite of what the yield is, you can see, of course, treasuries. We know one of the most conservative fixed income assets. This shows at a volatility of about 3.5, and your yield a little over 2, maybe a little over 3. Investment grade bonds around 4. Fairly similar risk profile to treasuries. And then corporate bonds, you get a little higher on the volatility scale, a little bit better yield. High yield or junk bonds, you get a very high return, almost 8%, sometimes 9, 10, 11, and also very high, so very high risk on the volatility scale. But in addition to the growing private equity markets that I discussed, the regulation on the major banks, the actual yield from private credit with the low volatility, and this is from Blackstone, by the way, from BCRED, which is one of their funds, but you can see low on the volatility scale and also an average yield. This is that 8.8% right here. So these are the reasons that private credit has grown so much as an asset class and is being used more and more by investors to diversify their portfolio, particularly away from other fixed income asset classes. Now, again, certainly it's not right for every investor. It really depends on your individual situation, what your risk profile is, what type of return you're looking for, and the time horizon that you have. But certainly, if you'd like to discuss your specific situation, my name's Andrew at Jesani Wealth Management. You can always reach me at 954-800-8552. Okay, thank you, everyone. Have a great day.